the weakness we saw at the start of the month was strange. I think it's particularly strange when, even in hindsight, commentators are struggling to put some sense to it. And I think in the context of where we are at the moment, if you put aside the last couple of years, we're actually in a relatively good environment for risk assets. The consumer, as we've just said about JD Sports, but the consumer is actually in relatively good form, particularly in North America. GDP remains fairly resilient. Inflation is under control. I think we're in a good place.
The problem is, and we were talking to our guest in the last hour, that it's very hard to forecast recessions. Economists admit it. We know the Fed, when it comes to execution error, there's been a little bit over the years. So how confident can we really be that we are on course for a soft landing? Shouldn't we have some insurance bets there just in case?
I mean, to a certain extent, you've got gold rallying, which is one of those sort of classic insurance pieces that you've got in a portfolio. To a certain extent, yes. I think that was part of the scare that we saw at the start of the month, where suddenly markets had moved. We'd been in this position where bad news was good news was bad news, and suddenly that seemed to reverse. We had a bit of a shock that's probably on fairly thin trading as well, where we saw weakness. But actually, I think we're in a relatively good place. I mean, everyone's going to be looking at Powell and what he's going to be saying, but all of the news would suggest we're now moving into a more accommodative phase.
How much do you have to move rates, though, to remain in what you deem as a good phase? Because it can get pretty dire very quickly from here if you continue to press the consumer too much.
I mean, I think they are treading a fairly fine line. I would imagine behind closed doors, most central bankers will be, to a degree, self-congratulating. The job that's been done.
The fight is done on inflation,
to
right?
a certain extent, exactly. But that dual remit that they have, which is inflation and jobs, that's a fairly fine line. So to a certain extent, yes, I think if they were to be too aggressive too early, that would actually probably scare markets. So one would expect, and it's pretty much priced in, a quarter-point cut in September. I think probably pushing for the full 1% by the end of year probably feels a little bullish. You would expect those several cuts going into the back end.
Yeah, still very bullish though on the US economy overall is the sentiment I'm getting from you then. What happens to the performance of equities then from here? I mean, the volatility is still anticipated to come through, but we still have the VIX back at that 14 mark. And if you're going to look at that could change things for you quite dramatically. But how much volatility are you seeing towards the end of the year here?
So, I mean, our view is, to a certain degree, we're starting to see some comfort from a wider spread market strength, where we saw that sort of very thin rally from the Mag 7 sort of last year and going into the start of this year. That's broadened out, which is a good sign. We're looking more at sort of areas like sort of domestic US, so smaller cap and mid cap US, where you've got that valuation differential as well versus the large cap sector, as areas that we'd be focused on.
But it's rotation, not necessarily leadership
That's more about
change,
rotation,
right? But not a leadership change, because you're still getting the mega caps really rising right now quite dramatically.
Absolutely.
Yeah.
One of your points that you don't like, illiquidity, and that was fascinating the other week, because when we saw the aggressive selling, it felt like there was nobody on the other side of the trade. And market architecture matters, something we've spoken about over the years when there's been a lot of pushback around how ETFs work. Well, the reality is we've seen a lot of ETF movement floating the boats of some stocks that shouldn't necessarily have gone up. So we're seeing more discovery around price action. But in terms of the herding around the Mag 7 too, another feature of the market. So what happens now? We've had a flush out, more breadth. Does that mean we have a healthier market and there's more liquidity?
I think to a certain extent, yes. I mean, ETFs and the rise of that market, you could argue, has pushed momentum in both directions. So, and it will get back. It's almost self-fulfilling. But to a certain extent, yes, I think we are starting to see wider, broader markets with decent liquidity. Obviously, the summer period anyway is always going to be thinner, which probably didn't help us earlier in the month.